Welcome to Finance, where your money becomes fun. I hold a master's degree in finance and did nothing with it professionally, but I used the concepts I learned to build wealth and economic freedom. I started this channel to help you do the same. Each video is a short explanation of a topic and how you can apply its concepts to your wallet, followed by a case study from my investing experience. I'm not selling you anything, but giving you knowledge. Okay, so we've arrived to stocks, the stock market. This is the primary reason I find finance fun is not just stock picking, but just understanding the stock market, because the stock market is the world around you. It's all the things, I'm recording this on Mac stuff. What you buy, what you consume is the stock market. There's very few companies that are large that are still private. There are some, but for the most part, a company will be, that you're buying their product or service will be on the stock market. And I keep on saying that, I don't want the heat, but I think if you put anything online, you're going to get heat. But it is the main reason I've been able to get where I am, is by purchasing individual stocks. So my journey, again, let's go back to the thesis and everything, is to have fun with this. I graduated from art school, from NYU's film school, and worked in entertainment and the like. And then I went to finance school because I just found this stuff fun, because I started investing in my retirement accounts and taking out CDs at the bank, and I was looking for more. I was looking for more knowledge on this stuff. So I went back to school and I find it fun. So I'm hoping that you will find this fun too. And hey, yeah, sure, have fun, but I want you to get to a point where you're not worried about money anymore. I'm not selling you anything except knowledge. Just keep on learning, and I'll teach you what I know. So this is going to be a little bit of a real basic episode on stocks. I am going to try to, give you the important stuff right now, and then there's going to be a ton of episodes where we look at all different aspects of the stock market. All right, so what is a stock? Stock is a share of the company. So let's say you have a company that, let's use real examples. I hate when people say, in finance school, you always have the widgets and the circles. It's like that. All right, we were talking about Apple, like Apple. Let's say really basic that they have 100 shares of the company. That means if you own all 100 shares, you own the company. So if you own one, you own 1/100th of the company. And this is great because in the market, you can buy and sell that share depending on where you think it's going to go. And we'll talk about value and everything later, but that's what a share is. We'll look at the numbers of individual stock and what they mean. Again, trying to make this really basic at this point. But one thing that is a little bit of an aha, moment, where Warren Buffett said years ago, Dow, there should be a Dow of 90,000. At the time, I think it was around 20,000. Dow is an index. It's 30 stocks. And Dow Industrial has been around forever. And actually, I'm not a fan of it, how it judges things. Anyway, that it shouldn't be a basis of the economy and everything like that. But he said that with absolute certainty because, in essence, yes, a stock, especially something like the Dow, which is supposed to be integral parts of the economy, should go up. Not just because of growth, growth is a big part of it, but but also because of things like inflation and things like just the value. So that share price should be reflective of how much money that company is bringing in. So let's say you have Procter & Gamble and they do Tide, right? So Tide, let's keep it simple. Let's say 1980 Tide was $2. Now it's $10. So that money, they're having larger revenue. Let's just say that the volume sales are the same. Their revenue has increased just because of inflation. Again, this is just the real basic concept of why Warren Buffett in the beginning principles of why there should be a Dow 90,000 and then a Dow 200,000, whatever. So we have that in our advantage, that our money, we're not going to just put in the bank and it's just going to stay there. But with the stock market, obviously, that there's a lot of risk. There's all kinds of horror stories. But horror stories are fun only on Friday nights. So let's go into the numbers of a stock, and here I guess we'll put up. I'll put up NVIDIA. You have your price, obviously. That's for one share. You things like CNBC or your brokerage account or whatever will show you things like the high and the low. These are obvious. The beta, we'll talk about that at a later time. That's basically how much it's connected to the economy, kind of like what I was just talking about with Procter and Gamble. They might have like a beta of 1. When things are 1, it's more close to it. And when it's lower than 1, it means I forget that it's less connected to the economy. If it's more than 1, it's more. If the economy is doing good, it's going to do great. If the economy is going in the tanker, it's going to tank too. The dividend is payment. So this is another real good part of what makes finance fun. Usually, a dividend is every quarter. There are companies and stocks that pay every month, like Oxford Lane that I talked about in a previous video. And then there's also, I think there's TGIF, which is I don't even know, I think it's a SoFi fund or something like that pays every Friday. But it's the company giving, if you want to really look at it in a basic way, it's the company giving you a little bit piece of the profit. So we use Procter and Gamble with Tide. They made $100 in their quarter, and there's the 100 shareholders. Each one gets $1. The dividend yield is the dividend per share, what we say, $1 divided by the price of the stock at that point. So it's always changing when the price of the stock changes. The market cap is, if you add all the shares together, and what do we talk about with Apple equaling $100? That's their market cap. So Apple, of course, is close to $3 trillion now. So you take all the shares, put them together. What is the size of the company? How much is it worth? And that's the market cap. Market cap comes into play with a lot of things where you look at a company, if it's undervalued, if it's overvalued, and then of course with acquisitions and mergers, and we'll go into that later. The other numbers, just to really understand, is let's go into. We'll go into the important stuff right now, and we'll leave it at that. The ratios profitability section of the CNBC page, and you can find this on your brokerage website or app or whatever. You have EPS, which is earning per share, revenue. This is a little bit self-explanatory. The other concepts like gross margin, return ROE, return on equity, EBITDA. We'll dive into those at a later point. This is just to get your feet wet with the stock market and how we're going to have fun with this stuff. But the thing that I'm always trying to teach something that I kind of learned, and whether it was in school or more times than not, just outside in life and in investing. But probably the most important number when looking at a stock, and it's for two reasons, is the PE and the forward PE. PE is the price divided by the earnings. So when you have a high PE, that means that let's say you have a PE of 100. The company's not bringing in a lot uh, relative, but there's a lot of optimism that it's going to be making a lot. So the PE, the price of the stock has gone up, not so much because of the earnings, but because of the sentiment that wow, this is a good investment because later on down the line. I'd be remiss if I talked about PE and didn't bring up the great way of assessing or evaluating the entire market or the value of a stock. Robert Shiller, who I think was a Yale professor, he's well known. You actually hear about his index, I think, with real estate. He's a really good in looking at valuations. His PE ratio over time, the mean is 17 here, and the median is essentially 16, 15.97. That's what he's saying historically a stock should be valued at, their price to their earnings. Now it looks like they're saying it's at 34. So, why did I just react that way? Because that could say that maybe there's a bubble happening, that things are being appraised or assessed that's more than is actually bringing in. So, when you have something that has a lot of optimism and excitement, you got to deliver, eventually down the line. So that's a great way of looking at stocks is the PE of how Wall Street is valuing it. And that brings you to the forward PE. Now, not every company has the forward PE. Luckily, NVIDIA is showing theirs. Usually, the forward PE comes from the earnings call, where they project what they're going to be making the next year and down the line. But it's the reason why PE, and really more so the forward PE, is what the market is looking at. That's what a lot of the big players, a lot of the big investors are looking at. I I definitely struggled with this at first, where you look at something like right now, we have what I think a lot of people would consider an undervalued company in Disney, where it's worth whatever, the market cap. But if you look at all the IP, intellectual property, and their assets, you go, oh man, they have so much more than what the Wall Street is valuing at it. But the reason why that stock is most likely at that point, there's all kinds of reasons, but most likely the big reason is because of the forward PE. Wall Street investors, they really care about not what you did for me yesterday, but what are you going to do for me tomorrow? They don't care about all that other stuff. They just want to see what is the future cash flow coming in. So the forward PE is something that is looked at first. So whenever you can find that, again, not every CNBC, not every company has it, but it's great when you do. You have to maybe do a little digging to find it if it's there. But here we're looking at NVIDIA at this time. Forward PE is a lot less because they're thinking they're going to be making a lot more money in the future. So that is the big lesson that I want to teach with just this introduction to the stock market, is that with everything you do have emotion, and you do have things like Disney. You go, oh man, Peter Pan's worth $5 billion by itself, whatever. But you can be. The lesson is you can be a cheerleader and you can be a fan. But that doesn't mean anything in regards to investments in the stock market. The big thing that most everyone is looking at is that forward PE and that PE. So it's sometimes tough. Sometimes you see something that you have an emotional connection to, and or you think it's unfair. There's definitely things like thoughts like that will go on, um, and like with sports players, or whatever, you do get a little emotionally attached as well to something, especially if it made you money, kind of thing. But that's it's tough. You have to take emotion out of it and look at things like these hard numbers. So um, again, just to recap, stock market is what I think is. I use this term a lot, but the great equalizer is something anyone can invest in. This is what has done the best for me. It has been actually individual stocks. This is where how I find it fun is looking at this stuff and having a shopping list, having um, just being also more cognizant in the world. Looking at things and seeing who made this um, and the more you learn about the stock market, the more you're going to learn about the world around you. Um, it should, there's the meme, stocks always go up. There is a contention of truth there, just like I said, with inflation, with macroeconomic things. Of course, if you have a company that is not that tied to the economy, there's a startup that's doing something new, it doesn't really pertain. But if you have something like a Procter and Gamble or something that's a staple, that they raise their price along with inflation and the economy, it will go up generally. And then let's see, we looked at the numbers again. They're pretty self-explanatory. I just did a few of them. The big things are, of course, price, market cap, dividend, and the dividend yield, revenue. But the big thing to look for in regarding investing and what we're going to be doing here is the PE and the forward PE. And again, really the forward PE. They're a fickle B word, Wall Street. They don't, let me repeat it, they don't care about what you did. They just care about what you're going to do. So with that, let's get to our You Did What section. This You Did What is Kraft Heinz, the 3-day rule, which I had just learned about right when it took its giant dip. And I'll explain what the 3-day rule is, and I'll tell the story of this investment. So it was February 2019. I was working in my office job, and I went for a walk, and I saw the headlines that the stock was down like 30%. So backing up, what is Kraft Heinz? Well, everyone knows Heinz ketchup, Kraft mac and cheese. They had a merger. I forget when. It was fairly recent to that time. Warren Buffett was heavily involved. I think he owned both companies, and they have a beautiful portfolio of brands and food items. Maxwell House Coffee, Hoboken, yeah, Oscar Mayer, Kool-Aid. There's a bunch, and when they merged, there was a lot of excitement because they thought that there was a lot of synergy. There was going to be a lot of cost savings. A lot of people. I don't think most people know that with all the major major supermarkets, the big food brands actually negotiate over shelf space and the like. So if you're a bigger company, you're probably going to have more sway in making sure that your products are at eye level. It's wild. We'll talk about supermarkets and the food industry in a video all itself. So anyway, they thought there was going to be a lot of cost savings. So it was heralded by Wall Street. But then this day, I forget what day it was, but it was like a full boat of bad news. They were cutting their dividend. They were writing down the value of their brands, saying that they were appraising it for a little bit too much on their books. I think there was an SEC investigation that they announced, and then I think they flat out just admitted that the cost saving wasn't really happening, that they had a lot of costs still. So I saw this, and I just learned about the 3-day rule. And the 3-day rule, anything like with this stuff is that there's never absolutes. It's not ones and zeros. Or black or white. There's always a little truth and a little fantasy in there. And the 3-day rule is that the first day of really bad news, there's a lot of selling, and that not enough selling happens, so that it trickles into the second and maybe the third day or further, just based on historical trends and the fact that, like I said, that there's people with shares they're trying to get rid of, and they can't for a reason. I don't know, but that's essentially what the concept is. So I waited a couple of days, and I think I bought it at 31 or 32, something like that. And I'm not ashamed of it. I thought that was a good investment. I made money. I kept it for a few years. I think I still hold a few shares here and there. We'll look at the chart. It really does trade within a channel, but channels actually I trade Dow Chemical in a channel. So like I set a minimum where I buy, and then I set a target that I sell. And that'll be a whole you did what on its own with Dow Chemical, and how you can employ that strategy with certain stocks that seem like they stay in a channel. But that's the 3-day rule. 3-day rule. I mean, it's like I always think of it like I've called Wall Street a very emotional, let's just say, the teenager. Remember when you had your high school sweetheart, and you would have a fight, and it was the end of the world. I never want to see you again. And then a day, 2 days later, and she or he is inviting you back into the house. It's kind of like the 3-day rule. I find it a little bit of I like when you buy these stocks that offer a little bit of a dividend. It actually has a nice dividend. I think it's around 4%. And every time I went to the supermarket, and I fortunately, I mean, I don't know, fortunately, whatever, I am a fan of Heinz ketchup. I've tried Hunt's. I don't know. But I would say, all right, that dividend that I got, I'm just buying the ketchup again. So there's no real loss here. So I found it fun. So that's the 3-day rule. I mean, another thing that a lot of people saying on Wall Street is something like that is like trying to catch a knife. Most times if you're trying to catch a knife, you'll hit the blade and you'll cut yourself. So don't try to catch the knife is what they're saying. The 3-day rule is I don't know, it kind of puts that knife falling in a little bit of slow motion or something like that, where you can grab onto the handle. So that's this. So what's the takeaway? The takeaway is the 3-day rule. The takeaway is also I thought there was an overreaction from Wall Street. And then the another thing to just keep in mind when we're talking about the food space and stocks like this is a whole video will be about how you build a portfolio of your own where you're in different sectors. But Kraft Heinz was 2019. It was something where everyone thought there was going to be a recession. I mean, you had COVID. But I thought it was a nice play on having exposure to stocks that should do well in a recession. They offered less quality, but cheaper prices. And I thought they were going to do well with that. It's like I've heard a rumor of Magic Johnson. Nothing age related. Magic Johnson is very successful. He's a businessman. I mean, he's in all kinds of things. But I remember early on hearing that Magic Johnson had like 80 Starbucks and Burger Kings, and he said something to the effect of well, in good times the Starbucks is going to do well, and in bad times the Burger King is going to do well because it's cheaper, and that's a good sentiment to have with portfolio building. But that's Kraft Heinz takeaway 3-day rule, selling, emotional Wall Street, finding that dip, and not being so quick to pull the trigger. Give it some time. Wall Street is a little emotional with their reactions as well, so it can help you better catch the knife. All right, that's the episode. Please subscribe, like, and comment any questions or topics you'd like me to cover in a future episode. Log on to finance.com to learn more, and let's have fun with finance.